Eli Lilly recently announced earnings for the second quarter of 2023. Their stock is up 72%, up more than 50% or just about 50% year to date, and we can see that the S&P 500 is only up 3%, about 14% year to date. So Eli Lilly is completely dominating the market over the last year. And so in this video, I'm going to look into some of the recent news that came out surrounding Eli Lilly, and it's pretty optimistic news, as you'll see. We're going to look into their financial statements, which also showed really strong revenue and earnings growth. And then I'm going to use a discounted cash flow model and figure out Eli Lilly's weighted average cost of capital to figure out the intrinsic value of the company. So right here we can see this article is titled Eli Lilly shares reach record high after completing 2 acquisitions. This is their record high stock price, as we can see right here. So definitely very, very good news recently. They point out right here some key takeaways. Eli Lilly shares hit a record after the company completed 2 acquisitions earlier this year. The deals expand Lilly's reach into potential diabetes and obesity treatments. And then also the 2 deals could have a total value of $2 billion if certain conditions are reached. They touch on the fact that they completed the July purchase of a drug called, or of a company called Versanis Bio, including its lead asset, Bimigurumab. I'm not even going to attempt to pronounce that, but you can see the drug right here. In a phase 2b study alone and in combination with the drug in Novo Nordisk, Ozempic, and Wegovy to treat overweight and obese adults. The deal could be valued up to about $2 billion depending on achievement of certain development and sales milestones, and shares of Eli Lilly gained 1.8% on Monday, having risen nearly 50% so far this year. So they're making some pretty big acquisitions right now, and that might be able to have a very positive impact on their business. This one is titled 3 of Eli Lilly's top drugs grew by over 40% in Q2, and Trulicity wasn't one of them. They point out that Trulicity remains the company's top-selling drug, but it might not stay that way for long. A drug that they have called Mounjaro hit sales that were just under $1 billion during the last 3 months alone. So very impressive revenue growth right here. They point out that the company continues to find diverse and vast pipelines of revenue to continue to grow their business. Trulicity has been a key growth catalyst for the business in recent years, but now there are other drugs that are growing at faster rates and could soon eclipse Trulicity in revenue. The diabetes drug Trulicity for Eli Lilly generated $7.4 billion in revenue last year, accounting for 25% of the company's top-line revenue, which was about $30 billion. Right here, they point out that the drug for the period ended June 30th for the second quarter generated more than, or basically $2 billion in revenue. However, a couple of their fast-growing drugs are closing the gap. Their breast cancer drug, Verziano, and then diabetes drug, Mounjaro, both of which generated more than $900 million in sales for the period. This is a small little graphic that shows their best-selling drugs in the second quarter. We can see Trulicity, the light red is 2022, dark red is 2023. Trulicity holds the majority of the revenue. We can see Verziano, Mounjaro, and this one, Jardiance, have combined for a lot of the overall sales revenue for Q2. Trulicity's sales were down 5% last quarter, and much of the company's growth came from just 3 drugs, Verziano, Mounjaro, and Jardiance, another diabetes drug. Those drugs all generated sales growth of more than 40%, especially Mounjaro, as we can see right here, massive growth. And they point that out right here. The real rockstar drug, Mounjaro, was approved as a diabetes treatment just last year, and its revenue skyrocketed from $16 million in the prior years in Q2 2022 to $980 million in 2023. So definitely massive amounts of revenue growth for their one drug, Mounjaro, as we can see from this table right here. Lilly's top line rose by $1.8 billion the past quarter. Those 3 drugs combined for $1.5 billion of additional revenue, and they could be the key to the company's future, approved to treat diabetes, but they also have the potential to be a game changer in weight management. In clinical trials, they helped people lose about 26% of their body weight. They point out that drugs' peak annual sales could top $68 billion. It wouldn't only blow out Trulicity's revenue, but it would also double the revenue for Lilly's entire business generated in 2022. So that would be over 100% year-to-year growth from 2022 to 2023. That would be very impressive, and Eli Lilly's stock price is obviously justifying that growth, as we can see right here. They're currently trading at 70 times earnings, so it looks like they could be an expensive stock, but the company has maybe one of the best drugs that they've ever had currently in their portfolio in Mounjaro. And if it's given the green light this year to treat weight management, then it could be a big game changer. They point out that Eli Lilly is one of the few stocks that's a no-brainer buy at this stage. It could be the first trillion-dollar company in the healthcare industry with the potential that the business possesses. And right now, it's likely to perform even better in the years ahead. So exciting news for Eli Lilly. Obviously, this stock has been growing exponentially in recent years. And on top of that, keep in mind, Eli Lilly also pays a pretty hefty dividend, as we'll see. So the fact that they're a growth stock and they pay a dividend, they've been growing almost a little over 400% over the last 5 years, 72% over the last year. So very interesting to see for Eli Lilly. Okay, so right here we can see their financial statements for 2020, or for the second quarter of 2023 to 2022. Revenue grew from 6.4 billion to 8.3 billion, so it's up 28% year over year. Net income grew from 950 million to almost 1.8 billion, so that's an increase of around 85% year over year. So massive revenue and earnings growth. And for the revenue right here, their United States revenue was about 5.5 billion of the 8.3 billion. And that was up 41% year over year due to a 39% increase in sales volume and only a 2% increase in prices. So you know that the revenue increases aren't just coming from price hikes or inflation. Eli Lilly is actually selling higher volume of drugs, which is definitely a good sign to see for Eli Lilly. Then if we go to page 7 here, we can see their balance sheet. Total assets increased from 49 billion to 54.8 billion. They have $11 billion of total equity, so most of it is financed by liabilities on their balance sheet, and of retained earnings, it's pretty much stayed the same at around $10 billion. Then lastly, on page 10, we can see their cash flow statement for the first half of 2022 compared to 2023. Operating cash flow came out to 2.3 billion, and then we can see right here that they paid out dividends of 2 billion, and they also purchased common stock of 750 million. So considering they had 2.3 billion of operating cash flow and they returned about 2.7 billion back to shareholders, it shows Eli Lilly is definitely prioritizing returning value back to shareholders. And that's definitely a good sign to see for shareholders of Eli Lilly. So right here, this is the discounted cash flow model. I'm using a 3% per year compounded annual growth rate for this model. And I got that from their historic growth rate. Free cash flow in 2018 was about 4 billion. In 2022 was 5.2 billion. So over 5 years, that's a compounded annual growth rate of 3.95%. The weighted average cost of capital for Eli Lilly's balance sheet is 2.8%. I got that right here. Book value of equity and debt was 10 billion and 38 billion. Their interest rate on their debt for their most recent full year, 2022, was 2%. Effective tax rate was 8%. 10-year treasury yield right now is 4%. Eli Lilly's beta is 0.35, so they're way less volatile than the rest of the market. And then we can see cost of equity. 10-year treasury yield plus their beta multiplied by market return minus the risk-free return comes out to 6.26% cost of equity compared to 2% cost of debt. Their balance sheet was about 80% debt, 20% equity. And so by multiplying the equity proportion by cost of equity, adding that to the debt proportion, multiplied by the cost of debt, multiplied by the tax yield, we get 2.8% for the weighted average cost of capital, which is what I'm using to calculate the discount rate for the discounted cash flow model. Right here, free cash flow in their most recent full year, 5 billion. They have a net debt position of about 16 billion, a little under a billion shares outstanding, putting their intrinsic value per share estimated to be $91 per share. So based on this, they would not be trading below intrinsic value per share at the moment. But keep in mind, this is based on the assumption that they're growing at about 1 to 3% for the next decade based on their free cash flow metrics. But if we're looking at their revenue and earnings growth, we saw that their earnings growth increased about 85%. So there are a lot of assumptions in a discounted cash flow model, and Eli Lilly has really proven over recent years, since about 2017, that they're growing in more recent years a lot faster than 3% per year. So if they're able to capitalize on their new Mounjaro drug and increase sales and profits and continue to grow at the rate that they've been growing, then they would be growing at a much faster rate than 3%. But these are their historic growth rates, so for the purposes of this model, I'm going to stick to them, but I encourage everyone to do your own due diligence. Right here, we have an industry analysis comparing Eli Lilly to two other healthcare companies, Pfizer and Merck. We can see Eli Lilly has the highest gross profit margin, the lowest net profit margin, lowest return on assets, and by far the highest return on equity. This could be a little bit deceptive because Eli Lilly, as we saw from their balance sheet, takes on a lot of debt. So they're able to increase their revenue and profits by leveraging their company's balance sheet, which shows an inflated return on equity metric. But judging by their competitors, Pfizer and Merck, it looks like the industry average might be closer to around 30 to 40%. So we'll have to keep an eye on that for Eli Lilly. Debt to equity ratio, clearly they have more debt, as I just pointed out, 1.5 ratio compared to 0.4 and 0.7 for Pfizer and Merck. P ratio, they're trading at 75 times earnings compared to 9 for Pfizer, 89 for Merck. And they pay a 1.07 dividend yield percentage, which is pretty good. It means they pay about $1.07 for every $100 you invest into Eli Lilly. Considering the fact that their stock is growing this much and it's primarily a growth stock, but they also pay a dividend that's higher than 1% dividend yield, I'd say that's pretty impressive return back to shareholders. So if you were going to compare these companies against each other based on financial ratios and dividend yield alone, you'd probably want to give it to Pfizer just because they have the highest earnings potential right here, highest net profit margin, and they also pay the highest dividend, and then they're also trading at the cheapest price to earnings ratio. Obviously, there are more things to consider when you're analyzing companies, so you don't want to just look at this at face value, but based solely on these metrics, you want to give it to Pfizer. Then to end off the video, I wanted to compare Eli Lilly to some other companies we've looked at. Right here, in the last video, I made a mistake. I accidentally included Chevron on the table twice. So to fill in the 10th spot, I put Eli Lilly there, but we can see they're definitely not trading anywhere near below intrinsic value per share. So far, Oxy, ExxonMobil, AMD, Chevron, Google, Albertsons, Alibaba, and Etsy are the only companies we've looked at that are trading below intrinsic value per share. We can see that for growth rate, Eli Lilly had a historic 3% growth rate, not good enough to get them onto the growth rate table. AMD had the highest at 83% over the last 5 years. For dividend yield, Eli Lilly was paying about 1.07%, not good enough to get them onto this table. Intel has the highest at 5.52%. For profitability, Eli Lilly gets onto both the gross and net profit tables. They had a third spot in the gross profit table at 76%, very high compared to the other companies we've looked at. Adobe has the highest at 86%. And then for net profit, Eli Lilly had a 21% net profit margin, coming in at 8th place. Oxy had the highest at 36%. Year over year revenue and earnings growth, Eli Lilly makes it onto both tables, which is very impressive. We've especially seen in some past videos that in the oil and energy industry, that those companies were showing year over year massive declines in revenue and earnings growth. So it's interesting to see how these different industries are experiencing growth, and then some other industries are experiencing declines during the same period. For Eli Lilly, we can see revenue growth was 28% year over year for the second quarter. Tesla had the first place spot at 47%. And then for earnings growth at 85% Q2 year over year earnings growth, very impressive, especially considering the fact that they were also profitable in 2022. Intel had a 400% year over year second quarter earnings growth, but we also saw from that video that in 2022 for the second quarter, Intel wasn't profitable. They lost a lot of money. So increasing 400% from a net loss to net profitability, in my opinion, is good news, but not as impressive or as consistent as Eli Lilly's 85% growth from strong profitability in 2022 to even stronger profitability in 2023. Then lastly, for stock performance, we can see Eli Lilly comes in 5th place, 416% return over the last 5 years. Tesla has the number 1 spot at 1,144% return over the 5-year chart. So based on this, it looks like Eli Lilly is very competitive, especially from stock performance, year-over-year earnings and revenue growth, and then also profitability. But for growth rate, dividend yield, and share price to intrinsic value, they're not really that competitive compared to other companies we've looked at. In terms of industry analysis, In terms of these financial ratios, Eli Lilly is very competitive, but the winner would probably go to Pfizer. And then based on this discounted cash flow model and the weighted average cost of capital, it looks like Eli Lilly is currently not trading below intrinsic value per share. So let me know in the comment section down below what you guys think of Eli Lilly. This stock is obviously doing really well right now. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.